He's back.
Buongiorno, everybody. Thank you all for joining us for another deep dive. I'm Brian Feraldi. That's Brian Stoffel. And as he just points out, I am back from a lovely week vacation in Italy. So thank you guys for sticking with Stoffel for last week's
and Justin
for last week's deep dive. Let us know in the comment section where you are coming in from. People from the UK, Boston, Clifton, Virginia, Dallas, Texas. Joao was confused if he's in Portugal or Vietnam.
They're real close. They're real close. So I understand.
It's so easy to get those two countries confused with each other. Well, Mr. Stoffel, we are here for another deep dive. This time we are doing two stocks that I've researched one of them previously, and the other one I have no idea about.
Yeah. This is not the area of my expertise. The good thing is that if you're watching this and it is, get in the chat.
Let us know.
Let us know.
Yeah. If there's anything that's going to show off the power of using Stock Simplifier to research a tool from scratch, these stocks will be it. So with that, today is August 11th, and we're going to be doing IONQ versus Rigetti Computing. You're going to see us research these using the Simplifier 7 framework. We're going to go over 7 aspects of these businesses. Let us know in the chat if you own either of these stocks. We always like to know if we are talking to current shareholders. From a difficulty level, Mr. Stoffel, some stocks are easy, some are moderate, some are hard, some are expert level. What do you think is the appropriate gauge for these businesses in terms of difficulty?
It's got to be expert.
Expert?
To me, yes.
Okay. Yeah, you're thinking this is about as hard as it gets.
Well, I mean, the thing is it's such a nascent technology that there's so much guesswork involved.
Yep. No position in either. We do have shareholders here.
Yeah,
Very
we do.
cool.
We've got some. Actually, I would say much more than I was expecting.
Cool. Well, let's start digging in. We're going to start with IONQ. Here I am in Stock Simplifier. We put it into the Simplify, and we get it going. How's the size here? Is it?
Yeah, that's good.
That's good.
Do one more. There we go.
That's too big because then, yeah.
Oh yeah, we're cutting off.
This is good. Otherwise, it pushes this down too much. Okay. This is a $16 billion market cap company. It is categorized as asset heavy. Stock Simplifier says it's only moderately difficult.
Yeah, Stock Simplifier is smarter than I am. So
okay, this is a company that looks like it came public in 2021-ish. It's a four-bagger since coming public, and it's a market beater. So it looks like a pretty wild ride there. But if we go max, what's max? Yeah, it's about up about 300% in total. This is a company with 1,100 employees, founded about 11 years ago. Let's take a look at some key stats here. So the company's profitability. So gross margin is positive. They're making money from selling whatever it is they're selling. Operating net free cash flow margins are about as ugly as it gets. Balance sheet, $2.4 billion in cash, just $44 million in debt. So strong balance sheet. And revenue growth is triple digit.
Hey, off of a small base, but still.
And on a trailing multiple basis, about 120 times trailing sales, but only 4 times book value for whatever it is. And for some reason, the buyback yield is negative 20%. So I have a feeling we're going to see some heavy dilution in there. But let's get into the gist of this business. IONQ builds quantum computers that use trapped ions as qubits, individually charged atoms held in place by electric fields, rather than the fabricated superconducting circuits most large rivals build. Around those machines, it sells quantum networking hardware, including a quantum key distribution line, quantum sensing equipment, and satellite and optical communication terminals. So all I know about quantum computing is insanely fast computing.
Yes.
Like from what I understand about quantum computing is that once this becomes a reality, it breaks encryption because the computers are so much faster.
Yep.
Okay. IONQ money arrives in 3 ways. A buyer can purchase a system outright and have it deployed on its own site, sign direct enterprise or government contracts, or rent time on IONQ's machines through a major cloud marketplace. So 3 ways they're making money. Support.
Is that they're making money right now, or is that
we'll dig into that? But
okay.
It seems like they at least have 3 businesses. I don't know if they're making money from all 3 right now. Support, maintenance, and application development work follow the systems already installed, and the company is still pre-profit, spending far more on research and developing the manufacturing build out than earns. And it recently brought a semiconductor foundry in-house.
Interesting.
All right. So they sell systems, some to enterprise or governments on contracts, or they rent time on their machines. I really like the idea of the rent time in the machines business.
Yep.
Okay. Who are the customers? The buyers are national governments, defense and national security agencies, national laboratories, and research universities, plus a small set of large enterprises. Institutions that want a machine on their own soil and under their own control carry the hardware line. So if you're buying the hardware, it's you buying the machine, installing it on-prem. Enterprises exploring quantum and drug discovery, material science, and financial modeling mostly reach the system through the cloud.
That's renting.
Yep. And most are still evaluating rather than running production work. So this is in the testing and experiment phase. What a buyer weighs in the architecture is IONQ's trapped ion approach competes against the superconducting circuits Google, IBM, and Rigetti built. So Rigetti's named right here as a competitor. The photonic design, PSI Quantum, and Xandu pursue, and the trapped ion system under Quantanium and Alpine Quantum Technologies also built. So it seems like they're doing it in a completely unique way compared to everybody else.
The trapped ion approach is the key differentiator, thus the name.
Got it. And then access runs through AWS, Azure, and cloud, the same consoles that carry rival machines. Very fascinating that they already have agreements that run through those things. All right, let's take a look at revenue.
All right,
so this is
a very, 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 very small number.
Very small number compared to what, a $14 billion market cap or whatever it is. But 54% is quantum computing and hardware. So this is selling to institutions, and then consulting, platform consulting and support. So everything else is 46%.
Now I will say, because I know that this is how Stock Simplifier does it, based for these cards based on the last fiscal year. They are at about 250 in trailing 12-month revenue right now.
Yep. So this number is built on the last 10K, and 10K is obviously a trailing number, and it's just designed to give you a split, like what size are the 2 businesses, and these 2 are fairly equally sized. Right now, their U.S. is 2/3 of revenue, international is 20%, and then Switzerland is 13%. I wonder if that's CERN.
Yeah, I'm sure it's CERN.
And you can see the details on there. Yep. And then do we have growth rates? We don't have growth rates, although basically both businesses should be going triple digit. Okay. Quality questions. How predictable is revenue? More than half of revenue is one-off system sales to governments and research institutions that buy this kind of equipment once every few years, one contract by contract. So totally revenue is going to be fluctuating quarter to quarter. Although in theory, the demand for this is going to be so high that while it is lumpy, the trajectory should be skyward.
Yep.
But if this becomes the dominant share of revenue, then this would flip to green. Revenue is far more predictable. Can it raise prices? Trapped ion systems are genuinely differentiated, but buyers compare architectures across several funded rivals, and no filing shows a price increase absorbed without lost volume. That's a fascinating thing. So it doesn't think that it has...
Well, no evidence. It's not saying that it can't.
Correct.
It's saying that it's never done it before.
Yep. So there's no evidence in the numbers that it has pricing power, but I have a feeling if this proves to be a truly differentiated architecture, then that could be developed.
Right. But that if is big if.
Is it recession proof? So this says no. Quantum computers are big, high ticket items purchased by, funded by governments. Each buyer, easy for a buyer to defer, and no downturn sits a long time's revenue history. Fair enough.
Yeah.
I would think that the demand for this is actually quite recession proof right now. What's their competitive position? Weak, based on their operating margin and returns, sit far below the comparative group. Has not appreciated.
Yeah, I mean, that's a tough rating right there, because it's just saying weak in general, but what it's saying is everyone's weak. So the competitive position might just be, it's impossible to know right now.
Well, the way that we program this is, again, look for evidence that this is true. By default, assume not. So you are like, they haven't clearly, it's clear that they haven't established themselves as the market leader, but if they do, then their competitive position would be stronger. But in your opinion, how exciting is IONQ's business? I mean, it's got revenue. That revenue is growing triple digit. It's a play on the quantum computing side. It has Amazon, Google, and Azure that it's selling through, and it's doing it in a differentiated way. So,
I mean, so for me, it's like a 3 or a 4, but I understand that it's a 5 for most people.
The main reason we ask this question is how interested in you this business, and how interested are you in pursuing the rest of it? So I think this is extremely exciting technology.
Yeah.
Okay. What phase of the business growth cycle is this company in? There's 5 phases you can be in. This is an incredibly important thing to know, because if you don't know what phase it's in, you don't know what to look at and how to analyze it.
I think this got it pretty right. Look at the red and green line just below.
Yep. So this is in phase 1. Revenue is growing. It's unprofitable, and 0 capital is being returned. By the way, we just changed the look of this so that it's now a line chart to match up with it. And yeah, that's green is revenue, and then red is operating profit. So over the last 12 months, they've lost $1 billion, and that's operating profit, not earnings or anything like that. So that lines up pretty darn closely with stage 1, I would say.
That is very much stage 1. It is the definition of stage 1.
Are they buying back stock? Nope. And then do they pay a dividend? Nope. This one's very clear cut. It is a stage 1 company. Losses are getting worse. So very clearly stage 1. Moat. Moat size. So this is the current size. So sunk on-site hardware and a large patent estate give real protection, but it's a thin moat with no source running at full strength. So 2 protections only: sunk installed systems and 610 issued patents. Other 3 sources are absent. Bounded durability. Rivals run other qubit architectures, so the patent fences off nothing that they need, and the returns thus far show no edge. So it's saying,
not surprising.
It's basically giving it switching costs for the institutions that already bought the hardware.
Yep.
However, the direction here, the contracted backlog tripled, and the patent pipeline keeps filling up. So the moat is getting wider. The backlog is outlining revenue. Obligations grew 298% versus 200. And so the backlog grew slightly faster than revenue, and revenue is growing blazing fast.
So, but think about that. The backlog is basically quadrupling.
Right. Amazing. And then the patents are filing. So 510. So yeah. So the only thing that it really has right now is intangibles. There are some switching costs once you buy it. But
I mean, that makes total sense.
Yeah. It's really about stage 1 companies. Often the only moat that they have is either counter positioning or intangibles through patents. I would agree with that. I would say this is a extremely small, if thin, moat. Currently,
to me, I would go 2 and 4, but
that makes sense to me. That makes sense to me. It's a thin moat currently, but the moat is rapidly widening, and we view direction more important than current size.
As investors,
as investors,
if we were business owners, they'd probably be about the same. But as investors, yeah.
Yep. Okay. Next, growth. Analysts expect revenue to grow 123% in the year ahead, roughly 290 million against 130 reported on the consensus of 11 analysts covering the stock. History supports the pace. Revenue has compounded 180% over the last couple of years. So the forward expectation is a slowdown.
Yeah.
The latest quarter revenue ahead, June quarter revenue was up 280%. Yeah, so this company clearly has product market fit. Like,
yeah, I mean, it's such a small base, but yes.
well, 246 million is not nothing.
No,
That's
I want to know what the average selling price for the hardware is.
But look how much it's grown. So 2 million, 11 million, 22 million, 43, 130, now 246. So yes, earnings are growing in the absolute wrong direction, but revenue growth is there. This is a company that's further along than I was assuming it would be.
Mm-hmm.
Is the industry growing? Absolutely. This is a massive industry. That's an important emerging industry for sure. And can new offerings drive growth? Quantum security, sensing, and space optical terminals are already ship. A semiconductor foundry just came in-house, and $2 billion of cash remains to fund the next one. The Clavix XG multiplex quantum security launch, a commercial INSAR capability, and a record 84 on-orbit optical terminals all landed in the June 2026 quarter. A working edge. Skywater closed on July 31st, putting a U.S. semiconductor foundry in-house, and Nexus Photonics was bought in the same quarter.
This last one's important.
Memorandum of understanding with Anduril and Sandia National Labs, plus the Tennessee Quantum, open buyers, IONQ did not have. So a brand new channel is open.
Anduril's a very fast growing company.
Yeah, I wish Anduril was public. If Anduril was public, I'd be a buyer, most likely, depending on the price. That'd be a company I would love to come public. Well, this one's an easy call to me. AI says this company has extreme growth potential.
I agree with this.
If you're a phase one company, you better have extreme growth potential. That's offsetting it. Okay. Management. Ooh. Okay.
I don't think I've ever seen Stock Simplifier be so brutal.
Okay. Management. Heavy dilution, a deeply negative margin, and soft employee reviews outweigh a perfect record against revenue estimates under a chief executive of 18 months. Stock compensation was 240% of revenue, and the diluted share count doubled over the past 4 years. Not surprising given a phase one company. A brand new management team, Niccolo De Masi, took the role in February 2025, only holds 0.5% of the shares, with a new finance, legal affairs, and business chief appointed later that year. Wow. Finance, legal affairs, and business chief, plus a new CEO.
What's weird is Glue Mobile is a mobile game developer, and that's where their CEO came from. That's just not something I'm used to seeing.
Well, I mean, it's not like, where else could you come from that you would have experience running a quantum company?
Well, right. No, that's fair.
Okay. Untested capital allocation, roughly $1 billion. Half of the pro forma cash position went to closing Skywater, a decision no reported period has graded yet. Yeah, so this just happened, right? So Christopher Monroe co-founded IONQ with...
He was the chief scientist until recently.
Yeah, and he left after 8 years. Okay, I don't know if this is... Well, this is going to be ownership of stock. I'm guessing this guy has a ton of options or stock-based compensation that's going to be vesting. So this is how much he owns right now. It's like nothing. And he came from Glue Mobile, heading the company that took IONQ public. He's a Cambridge physics degree and under 1% of the shares. Okay. Do employees like working here? No. Well,
I was surprised there's 1,000 of them. That's a lot.
A thin base. Employees don't like it. Do they beat expectations? Yes, they've beat expectations in 8 out of 8 quarters. Well, as you know, that's how I view it.
Matters to you. Yeah,
that's what matters to me. Do you exceed expectations? Are they shareholder friendly? No. Hard to be shareholder friendly at this stage of the game. And then how strong are operating margins? We know that that's going in the wrong direction here from an execution standpoint. Revenue versus estimates. So revenue is way more important at this stage than earnings are.
Yeah, earnings don't matter.
They've beat 100% of their last 8 quarters on a revenue basis. Only 3 of 8 beats on an earnings. And look how dramatic the earnings.
Yeah, earnings don't matter.
Yeah.
It's revenue. It's all
Yep.
revenue.
It is totally revenue there. So I'm going to give it a,
I think decent to good is fine.
yeah, I'll go good. To me, I care about revenue execution. That's the thing that I care about at this stage. The other stuff to me is more fluffy. But that's the thing that the market is going to be judged them on. From a shareholder friendliness perspective, the dilution is obviously high. It's going to be obviously high, but the market is rewarding what they've been doing.
Yep. Well,
So,
and there's no one that's buying shares that does their homework that's surprised by this.
nor should you be.
Being diluted.
Yeah. This is why it's really important to know the phase that the company is in so that you can judge them honestly. So Stock Simplifier says 1, I'll say 4. Okay. Risk. So shocking. This is a high risk company. IONQ says it has not produced a scalable quantum computer. 3 customers supply over half of revenue, and a named rival architecture could make its system obsolete. The product is unfinished. IONQ's own filings say it has not produced a scalable quantum computer, and the business could fail if it cannot overcome the barrier to doing so. 3 customers.
That's pretty important.
Yeah, I would say so. 3 customers are half of revenue. A rival architecture could make it obsolete, and export controls plus government budgets setting demand. And cash buys time, not answers. It's got $2 billion in cash, removes financing risk, but it does not make the technical problem or the customer concentration any smaller. So huge customer concentration risk. It is both a disruptor and could be disrupted. So you are very much betting that they are correct with their architecture. How much is outside of their control? Export controls, government budgeting cycles. 2/3 of is from one country, and then how healthy are the financials? Well, this says just basically plenty of cash. Although is that after the purchase? No, so that wouldn't include the $1 billion purchase that they just made, right? Because the quarter ended June 30th, and then they made $1 billion purchase. Oh, yeah. Well, we'll check that in the financials. Actually, we can do that right now. So we're on the risk section, but if we go to the financials and then we go to the balance sheet. So they have.
You can go to quarterly too.
Yeah, good idea. Let's go to quarterly. So as of the most recent quarter, $6 billion in total assets.
But cash was
2.1. No debt. All right. So they still have $2 billion in cash, but that is, again, the transaction happened
after the close of the quarter, right?
July. So
like
we were on the risk section
2 weeks ago.
Either way, this is very clearly
definitely a 1.
It's definitely a one out of 5. It's as risky as it gets. Valuation. Well, Stoffel, how do you value a company like this?
I have no idea.
It's very difficult. There's a couple of ways that you could do it. So the price to sales ratio is going to be your only multiple that works. Price to gross profit could also work here. So it looks like the stock got up to
742 times gross profit.
Yeah, but now just 226 times
just 227.
And this is compared to its own trading history, right?
Yeah.
So that's a limitation of trailing multiples. You can basically look at it compared to your own trading history. Is this a company we should do TAM analysis on?
So we could. I've got some rough numbers, but I mean they're very, very rough.
So
and I did this.
For those that aren't aware, TAM analysis, you basically look at what could this company be worth if everything goes really well, and then you put odds on that happening, and then that gives you a rough estimate of what the market cap should be, which adjusts for the odds.
All right, so I'm going to kind of bounce around here. Base case SAM, this was through Claude, put it at 20 billion.
Okay.
And this is for 2035.
Okay, so that's 10 years from now?
Yep.
Yep.
So then you can choose what you want the bear case and the bull case to be then.
I'll go 100, and yeah, that's just as this is the how big is the pie that they're going after? How much revenue opportunity is available? So I'll go 10, 20, and 100 by 2035. Okay.
Market share, base case 20%.
Okay.
And then you can choose what you want the others to be. And then margin, base case, I would say 17%. And look, this is a business model that's unproven. We have no idea what this could
Their gross
really,
margin
really
is
be.
40%. So we do know that, right?
Yeah.
So a company with a 40% gross
But-
margin, I would say a 10% profit margin is
But
probably
most of the profits now are
hardware.
on-site machines. Once you
Yep.
start renting it out, those have different margins.
Sure. So let's, again, bull case will be, let's go 25% bull case,
Mm-hmm.
10% base case, 5% bear case.
Sure.
Future PE ratio, 15, 30, 45. Sure. So there you go. So future market caps. So what are the market caps 9 years from now? If get
Well, the important thing to point out is I see the base case. The base case calls for the market cap in 2036 to be 12 billion. Is that correct?
Yep.
And today the company is worth 17 billion.
Yep.
So let's just be super clear. If they hit the base case and they have a 20% market share of a $20 billion market, which is what that basically means $4 billion in revenue with a 10% profit margin, you're going to lose a lot of money, a lot of money.
And you're going to wait 9 years to do it.
Yep. So the most important sell on here is that one you just clicked on. How much weight do we give the bull case? That's everything.
Yeah.
It's literally everything.
The bull case is this is the 20 bagger.
Yep.
That's the bull case. So the thing that matters most to your analysis is what are the odds that this company achieves that?
Yeah. Yeah. And
10%?
so to me, this is all about position sizing.
Totally.
Like I could own this. Would I make it a 5% position? No. Now, we know people who have more than 5% of their portfolio in it. And part of it's because they invested in it a long time ago. But they probably also understand the technology better than others as well. Because like Fateh was asking, would I consider investing in this industry in the future? Sure. But I have to put the time in. I've got to put the time in to learn more about this.
Well, but Bezos has a great quote about this. He's like, he says, if there's a 1% chance of you getting 1,000x return, right?
Mm-hmm.
Or maybe it might even be 10%. If there's a 10% chance of you getting 1,000x return, you should take that bet every time.
Right.
Right.
And
because it's like
the more times you take the bet, the more likely it is that you're going to hit.
And
don't bet the farm on each bet.
Position sizing is absolutely important. So I'll say 10% chance. 10% chance this company works out. If you buy a 10% chance of it working out, a 10% and then a 90% chance of you either of you getting
basically wasting
wiped
your money.
out. This is wiped out. 80% chance of you getting wiped out. 10% chance of you treading water. This being dead money. But if you think it's a 10% chance, then you should be willing to pay. The combined average market cap today would be essentially 46 billion if you average all these out. Now,
and I agree with what
Good.
I agree with what Investing with Confidence said, and the ifs are everything. If it can scale, and if it can achieve superiority, those are two big ifs. But yeah, then I would lean heavily towards that right-hand column.
If it gets the quantum computing computer out there, that dramatically lowers the risk profile. And then if it starts selling them, that also dramatically lowers the risk profile. So no surprise on this company right now, you're playing the news game. It's what is the news that comes out, because that's going to drive absolutely everything. So it's a lottery ticket, and it all comes down to what are the odds that you think the lottery ticket's going to pay off. If you think it's 10%, then the returns are going to be stellar.
Fantastic.
Stellar. Totally. But from a valuation standpoint, given its just price history at, call it $50 a share, I'll go fair valued.
I would give it a 2. That'd be where I would.
You'd give it a 2? Okay. So it's expensive, but there. On the flip side, this is an important point. When you're dealing with companies like this is something that David Gardner taught me. You want them to be overvalued.
Oh yeah,
you
absolutely.
want them to be expensive. Why? Because
so they can get money.
Because then if their stock is extremely expensive, they can raise capital at very attractive rates, minimizing dilution and giving them the capital they need. If this company was, let's just say the stock fell 90%, they would have to sell way more of the business to fund their future selves. So David Gardner, this is definitely a David Gardner style business. He looks for overvalued, and that makes the company more attractive, not less.
Yep.
More attractive.
Counterintuitive, but true.
Yeah, it's so counterintuitive. But if you're going to invest in companies like this, you actually being extremely overvalued is more of a positive sign than it would be for any other type of business. So I'll call it expensive. All right. So overall, this is an exciting business that's in the startup phase. The moat is thin, but it's growing. The growth here is extreme. The management team I voted as good. The risk here is very high, and depending on your definition of valuation, it's extremely hard company to value. But if it hits, wow, could this thing hit? So this to me is a classic watch list stock. It doesn't appeal to my investing style, but I understand why this company has done so well and so many people are interested in. With Stock Simplifier, once you do all these, you can actually get this cool graphic here. I'll zoom in on this. You can actually get too far. You can actually get this one-page summary of kind of everything that we did, and you can save that. But I'm going to go ahead and set a price alert on this company, and let's just call it $34 a share is what would probably interest me.
Brian, we've got a couple people. We got a couple people asking, how do I use this application that we're just using?
How do you use it?
Stock Simplifier. How do they get access to it?
Oh, well, share the link.
All right. There we go.
Are there any, while we're here, are there any financials that you would like to look at this company?
I would just like to look at the cash outflows, free cash flow, and just see how much do they tend to lose on a quarterly basis.
Yep. So
okay, so that's not the end of, well, I mean, so if you reduce that 2 billion to 1 billion based on how that acquisition went, that's not a super long runway. You're going to be diluted moving forward, most likely.
Totally. Which is why you want the stock to be overvalued.
Yep.
Their CapEx is actually very low. Capital expenditure of 10 million. That seems high. Their stock-based compensation.
With a new foundry, that might change.
You're right. That will make it much more capital intensive. But the free cash flow here, while big negative numbers in a percentage basis, 114 million, let's just call it 150 million a quarter in negative free cash flow, at least historically, compared to 2 billion or 2.6 billion in cash, tons of runway. So what their cash balance looks like after making that acquisition in June is going to affect their cash runway. Yeah. All right. With that out of the way, let's go ahead and transition to RGTI, Rigetti Computing. All right. This is a company that came public same time, 2021, had a huge run up. When was this? 2025. And then have come crashing down to earth. It's a market loser since coming public. It's in the semiconductor space. The market cap is a third, founded 2 years earlier, and almost 1/8 the employee base of IONQ. Some quick stats. It's also making money selling its product. The losses it's further behind from a business growth cycle phase. 400 million in cash, 7 million in debt. Revenue is negative. That's interesting. Down. Price to sales is 800. Price to book is 10.
Now I'm going to interrupt you. This is a pre-revenue company.
Well, there you go. Well, let's learn about this business. Rigetti is a full stack quantum computing company. It designs its own superconducting quantum processors using a chiplet design that wires small chips into a larger machine and then builds them into a Fab 1, which it calls the industry's first dedicated quantum device plant.
So it seems like both of these fabricate their own chips. or have plans to,
Yeah.
which
What
is interesting.
What it sells today is mostly complete quantum computers that research institutions install and run alongside paid research works and cloud access to its own machines. Same business model.
Yep.
The money now comes mainly from selling those machines outright, and each sale is booked when the system reaches the buyer. So revenue arrives in lumps, hence the negative revenue. Research engagements and cloud subscriptions sold through Amazon, Microsoft, QBraid, and its own service make up the rest. What's distinctive is that one company owns the chain from chip design through application to cloud delivery, funding years of building ahead of a market that barely exists. Let me read that again. What's distinctive is that this one company owns the chain from chip design through fabrication to cloud delivery, funding years of building ahead of a market that barely exists.
I mean, it's basically what it would be like if Amazon or Google like bought Broadcom and Taiwan Semi.
Sure. All right. Collaborative research and professional services is 94% of revenue,
or $7 million.
It's $7 million. And the quantum computing access, the better of the two businesses, is 400,000. Okay. Who are the customers? The buyer is an organization that wants quantum computers years before it goes mainstream, and most of them now buy a machine rather than own research equipment. National science and defense programs carry the business, from DARPA to UK's National Quantum Computing in India, and they increasingly install and run these systems themselves. Large companies like Standard Charter, HSBC, and Moody's buy research work and cloud access, which Amazon sells. They are funding capability and learning, not solving a production problem. So the purchase is a bet on being ready when quantum computers turn useful. Weighed against IBM, Google, Microsoft, IONQ, D-Wave, and other builders, Rigetti's draw is that we'll hand over a complete machine to install on site, so the buyer controls the hardware rather than renting a time. So
love that. I don't love that.
Their business model is very much the hardware.
Yeah.
That's what they're going after.
It's kind of like they don't have a choice because their architecture matches what IBM already has. So they need to differentiate somehow. Yep. And IBM's smart enough to say, well, we don't want to sell the hardware.
From a geography perspective, US is half, Europe is other half, Asia is 3%, but the numbers here are so tiny. It's basically irrelevant. Business quality. How predictable is revenue? It's unpredictable. They're based on grant cycles. Can it raise prices? Revenue comes from negotiated government research contracts, not list prices, so margins are deeply negative with no expansion. How recession-proof is it? It's going to be lumpy. And what's their competitive position? They're subscale against larger rivals where scale is the edge and no peer group to verify returns. It positions grades conservative to weak. I agreed. Well, still,
I agree.
Is this an interesting? Yeah, I'll go with 4 personally. It's an exciting business, but they seem to be, at least for now, focused more on the hardware, which is not an exciting business, versus the renting of the business, which is more exciting. All right. What phase of the business growth cycle is this in? This is another phase 1 company, although the revenue is down from last year. So 10 years. So revenue was red means down, green means up. Operating profit is down. By the way, doesn't going to a line make it so much easier to tell?
It really does. Picture
it's in
1,000 words.
Yeah. So match up this chart to this picture here. This is a phase 1 company. Phase 1 company. No buying back stock, no paying a dividend. This one's an easy call. They're phase 1. Moat. Very similar numbers here to IONQ. Rigetti has a thin moat. Its patent estate is a real but bounded source with no source in its strongest level and returns that still lag. One real source, the chiplet patent estate, sits above its weakest level, lifting the moat to thin. Nothing's at full strength, and the returns are not there to prove out it has a moat, but the moat is widening. Patent count keeps rising, and the qubit count climbs towards a larger module system with no barrier eroding. More chips. Its qubit count scaled from 9 to 36 to 108 with 1,000 plus qubit system now planned. And yeah, so its edge is getting wider, even though if it's thin, right now. I'll give it the same grade we gave to IONQ.
Yeah.
Growth. It better be insanely high growth potential.
Yeah.
Analysts expect revenue to grow 228% next year to 23 million. 13 analysts think so. Huge jump off a tiny base. The backward history is mixed and the ramp has already started. Revenue hit 5 million in June against 1.8 million a year ago. On the new Novera sales, early evidence in the project ramp has begun to operate. Let me take a quick second to go back to the business phase here and go into the deep dive section here. What was that? Customer profile, revenue breakdown, geography, key operating metrics, qubit count. The flagship system staled and is expected to reach the Cephas 1 in May 2026 is expected to reach this. 2 qubit gate fidelity. Yeah, you got to learn a whole new language to analyze these companies.
And that's exactly what I'm talking about. Yep.
Yeah. I was wondering if the deep dive had the breakdown of it. Either way, I'm also very comfortable just saying what's the growth potential here.
A 5. I mean,
it's 5 out of 5.
Yeah.
Management team also poor. Missing revenue estimates, heavy dilution, and a widening operating loss outweighs the 543 million in cash and no new equity invest. Rigetti came in below analyst revenue estimates in 6 of the last 8 quarters, the weight that pulls the overall management down. I agree, Stock Simplifier. The real capital offset management raised money. The losses are rounding. Just Chad Rigetti, founded, but he left in 2022. Founded the company and was a founder. He has since departed, no longer an officer or director. Okay. This guy owns 1% of the stock, $41 million. He's been president since 2022 after running this. An MIT doctorate, owns about 2 million shares. Do employees like working here? Similar results. Do they beat expectations? Let's go to the execution tab. Miss. Beat. Okay.
It is tough because it's grants. Like that's what most of this is, are grants, which is not what Wall Street analysts are adept at evaluating.
So you think that's more of a fact of the business model makes this
right now
unpredictable? So does that mean that if you were to grade management here, you would grade them kinder?
I would grade it as it's impossible to make a grade. That's what I would do.
Well, from a percent of consistency, personally, I'm like, did you make the numbers or not? Right. And I care about revenue numbers. And the answer to me is no, yes. So I call that a mixed track record. Are they shareholder friendly? The dilution is huge. Are they not? So I'm going to give this company a 3 management team, and that might be generous. I'm going to go 2. I'm going to go 2.
I would go 2 as well.
I think this is a 2 management team. They don't have a ton of stock. The founder is gone. Their execution history, at least until very recently, was poor. So 2. We don't have any other data to judge management team on.
It's like there's very little to base these opinions on.
Yep. Risks. Well, 3 of the 4 factors are at their worst. Concentration, disruption, and outside fortress. Offsetting that is the balance sheet. This one's easy. How risky is it? Extremely risky. Valuation. Well, price to sales. What are they trading at? They're trading at 400 times sales. Look at this. They were down to 10 times sales. Was this a company that was worth only a couple $1 million?
It could have been.
Wow. And again, when companies are on this stage, overvalued is more of a positive sign than it is a negative sign. I'm not going to do the TAM analysis here, other than to say, if you believe that this stock is going to be a home run, what are the odds of that happening? So I'll just call it moderately expensive. So same results here.
So just to put this in perspective, 3.3 was your score for IONQ and a 2.9, and they both got the same valuation rating.
There you go. Yeah, there you go. Okay. No capital return. We saw the mixed earnings and everything. I will say that their runway isn't their cash runway does not engender a ton of good faith right now. So they've got, I think, about $350 million in cash and short-term investments.
At the same time, over the last 12 months, they've burned through about 90 million. So that's like 4 years worth of cash. But if they ever start ramping up, because their whole thing is being fully vertically integrated.
Yep.
When you ramp that up, that's going to take cash.
Sure is.
That we said you were going to be diluted with IONQ, and I think you probably will be. I think you'll be even more diluted with Rigetti.
I totally agree. All right. I'm ready to call this one. Are you?
Oh yeah, totally.
Yeah.
If forced to choose,
yeah.
IONQ.
If forced to choose, what would you pick?
IONQ, definitely.
No, me too. No doubt. Why?
They actually have some business.
One,
they have a differentiated architecture. They do have rivals.
Yep.
We weren't clear about that. They do have rivals, but not IBM.
Both these companies do. Both these companies do.
But not IBM level rivals. Whereas Rigetti has to compete against IBM with the same architecture. And IONQ could lose to IBM if IBM's architecture wins the day.
Sure.
But they don't have well-heeled rivals using the same architecture as IONQ does. I will also say that I dug into the ownership records, and it does look like their chief technology officer was one of the co-founders of IONQ, and that person is still on board.
Okay. At Rigetti.
No, not Rigetti, at IONQ.
At IONQ. Okay.
Yep.
At this stage of the game, management and revenue execution to me are the whole ball game.
And the hard thing is that this is both a business execution and a science execution.
Sure.
You have to get both parts right. Like they could figure out the science and blow the business. It seems like they're trying to get the business set at Rigetti right now, but the science has to be there too.
Yep. And Fatih says there's also another strong player, D-Wave. Well, I don't think we have time to go through three stocks all in our hour here, but yeah, there's probably an ETF out there that just buys a basket of these things, and that would probably be my preferred way to play it. But for this matchup, to me, IONQ is the very clear one that I would bet on. It's got the better balance sheet. It's further along with the development. The management team is executing better. Revenue is growing triple digits. So if you think about the scale of the business growth cycle, Rigetti is still really towards the left end of phase one. IONQ is more towards proving out that the execution is real. Both of these companies are lottery. Both of these companies are lottery tickets. So you're betting on the architecture and the execution. So both are extremely high risk. But for me, if I was to pick one, no doubt, IONQ would be the one that I bet on.
I am fully agreed.
Cool. Well, thank you guys so much for watching. If you are on our newsletter, which you can sign up to at longtermmindset.co, tomorrow in our Wednesday newsletter, we're going to be putting out 4 different matchups for stocks to vote for. We are keeping them themed based. So they're going to be like Taiwan Semi versus ASML, for example, if you want to do that. So if you have suggestions for stocks that you would like us to do a heads up match on, please email us. Please put comments below on whatever platform you are watching this in, and we'd be happy to take them in to do further deep dives and more research on. If you want to sign up for Stock Simplifier, Stoffel, if you could put the link below, that would be great. And thank you guys so much for watching. We will see you next week. Bye everyone.